Hello friends, welcome to my channel TJ the Tax Accountant. It's a space where we discuss the basics of tax accounting. Before we start our today's presentation, please remember to subscribe to my channel, and if you like the video then please do click the like button. So today's topic of discussion is book tax differences. So this topic will be discussed in two parts, and this is the part 1 of our discussion. So now coming to the point of what are book tax differences. Book tax differences are nothing but a difference between the treatment of a transaction as per the local GAAP and as per the local tax laws. So the difference in the treatment of these transactions in the two sets of books of accounts can create book tax differences. So there are generally two kinds of book tax differences. First being the permanent difference. So as the name suggests, permanent differences are created due to the differences in the tax laws and GAAP principles, and they are permanent in nature, so they never reverse. There's no timing differences in permanent differences, and they never reverse, and hence they are not reported on balance sheet. So permanent differences may increase your taxable income versus your book income, or they may decrease your taxable income versus your book income. And the common examples of permanent differences are any piece of non-taxable income. So the local tax laws may fully exempt a kind of income which you have recorded, and on the flip side of it, there could be a piece of expense in your books of accounts which is fully disallowed, and that would create a permanent difference which will drive up your taxable income versus your book income. And as I said before, these are permanent in nature and they never reverse, so these pieces of differences are not recorded on balance sheet, and you generally find your permanent differences when you're scanning through your P&L statement. So you can figure out all the pieces of expenses and all the pieces of income on your P&L statement to determine whether there is a difference in the treatment of those items as per your GAAP accounting and as per your local tax laws. So the other kind of book tax difference is temporary difference, which is recorded whenever there's a timing difference between the recognition of a transaction in your GAAP account versus in your tax return. So these differences, as the name suggests, are temporary in nature, and they do create a difference in your book tax income, but that difference is reversed in a subsequent year of when you file your tax return for the next year or a year thereafter. So these differences generally include accrual of any liability in your books of accounts, but your tax law may not allow the expense deduction of that liability unless it has been actually accrued. So the common example could be a bad debt reserve. So you may recognize a bad debt reserve on your balance sheet and book an expense on your P&L statement on the basis of an estimate of the amount of bad debts you expect to incur in the next year. But when it comes to the tax return, you are allowed to claim a bad debt expense only if you have actually incurred the bad debt expense and you have actually written off the balance from your books of accounts. So you might treat that bad debt expense as an expense in current year, whereas on your tax return you will get to deduct that expense from your taxable income in the subsequent year. So which creates a timing difference. So it does not create a difference of deductibility and non-deductibility. It just creates a difference of the timing of the deduction. So in the event of temporary differences, there is never a tax expense impact of temporary differences because you recognize a benefit under your deferred tax expense account, and then you will have an offset to that benefit or expense in your current tax expense account. So the net of the two is always zero. So hence there is no impact to your current tax to your total tax expense when you are dealing with temporary differences. So now moving on to the expansion of temporary differences. As I said, we roll the temporary differences forward on our balance sheet, so they generally create either a deferred tax asset or a deferred tax liability. So a deferred tax asset is created when the temporary difference will result in a future benefit or cash inflow in the form of tax refund or a tax credit. So the common example of a DTA or a deferred tax asset is the carry forward of losses. So if you have incurred a loss in the current year on your tax return, you are allowed to carry forward that amount of loss and set it off against your future taxable income. So that will create a deferred tax asset, because when you would report an income in the next year, for the book purposes, you would still say that you have an income, but on your tax return you will say that I do not have an income because the amount of income is reduced or completely eliminated to zero by the amount of carry forward losses. So that creates a deferred tax asset. The other examples are like tax credit carry forward and any expense that you have accrued in current year, which you're not allowed to deduct on your current tax return, but you will get to deduct it in future years. So that creates a deferred tax asset. So on the flip side, deferred tax liability will result in a future outflow or a future payment of taxes, and these are recognized for the effect of future taxable items. So the common example is the difference in basis the basis of your assets as per book and as per tax return. So you may value asset at a higher amount for the purposes of books, whereas the calculation of basis in an asset on tax return is governed by tax law. So if you have a higher basis on in your books, then you will claim higher depreciation in your books of accounts versus your tax return, which will create a timing difference on your book and tax numbers, and it will because your basis in asset is higher on your books, you will have a lesser depreciation on tax return, and even in future years you will have a lesser depreciation on your tax return compared to your books of accounts, and that will create a future outflow of tax, and hence it is recorded as a deferred tax liability. And the reason it's a temporary difference or it's in the nature of a temporary difference is ultimately on both your books of accounts and on your tax return, the value of the asset will go to zero at some point of time in future. So there would be no book tax differences going forward from that point on. So that's what creates a temporary nature nature to this kind of book tax difference. So now moving on to book basis versus tax basis, which is nothing but the basis on which you value your balance sheet for which is governed by your local GAAP guidelines, and the tax basis is nothing but the basis on which you value your balances on your tax return, which are driven by the local tax laws. So the deferred taxes are the effect of the differences between book and tax basis as of the balance sheet date, which generally is driven by the same financial period, which is followed by the tax return. So it could be a calendar year which ends on 12/31, or it could be a fiscal year which ends on March 31st. In some places it could be June 30th or September 30th, depending on whether you are a corporation or a partnership entity. The tax basis balance sheet is prepared on a double entry accounting system maintained on a tax basis of accounting. So the tax basis is, as I said before, is always computed on your tax return because it's driven by the local tax laws. The tax basis balance sheet analysis compares the assets and liabilities on the tax balance sheet versus the book balance sheet, and the differences in these two amounts will give rise to the temporary differences. So just to repeat our previous discussion. So any difference in your bad debts reserve, which is booked on your book balance sheet versus on your tax balance sheet, will give rise to a temporary difference for the transaction of bad debts. So quickly taking a look at an example for book basis versus tax basis. So in this example, you can see the book basis for cash is same in like 10 out of 10 times the cash basis for book and tax will always be equal, because there's no other way to value cash. Inventory may have some differences, because you may record some inventory reserve. The accounting or the finance department may believe that the closing stock may not be of the same value in future years as it's being valued now, so they may put up a reserve against it, but that won't be allowed as a deduction on your tax return. But it will be allowed as a deduction on your tax return when you actually incur that loss on your closing stock. So that creates a deferred tax asset, because your tax return basis is higher than your book basis in your inventory, and the same would go for the bad debts reserve. As you can see, there's a receivables on your book and tax for 7,000, but the tax balance sheet does not have a bad debt reserve, but it will be allowed in a future year when you actually incur the bad debt loss. So that creates a deferred tax asset. And then for an example of deferred tax liability, you can see the book basis has a higher fixed asset value compared to your tax basis, so which means that there is a basis difference of 1,000 between book and tax. When you multiply it by your depreciation rate and times the tax rate, that would be the amount of deferred tax liability that this difference is creating. And then you then arrive at your net fixed asset, which is like 7,000 for book and 8,000 for tax, and your temporary differences keeps rolling on until both the book and tax report zero assets, which are net of full depreciation, which is being recorded for both book and tax. Hope you find this video useful to understand the concept of temporary and permanent differences, or the book tax differences. And please do subscribe to my channel if you like the video or if you like the content. And I have some more topics to cover, which I'll be loading pretty soon. So I'll be uploading a second part of book tax differences. I'm planning to make a video on tools to review tax provision, and a separate video for some practical examples of tax accounting. So please do watch out this space, and again, please subscribe to my channel, and I look forward to meet everyone soon with a new video. Thank you.